Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm very happy to be presenting this week's topic, which is titled, Leverage Your Capital to Increase Returns. Now, leverage can be very powerful when it comes to investing. Using leverage allows you to turn a relatively small amount of capital into significant profits. Now, the only way to take advantage of leverage if you are trading just stocks or ETFs is to borrow funds from your broker to create a position. It's also known as using a margin account. Now, this is not always preferable or possible for every investor. So one of the benefits among the many of trading options is they allow you to greatly enhance the power of your capital. And my goal in this presentation is to show you how. It starts with the question, why trade options? And whenever I ask myself an investment-related question that starts with why, my first thoughts always go to the 7 secrets of making money with VectorVest. This presentation was created by our founder and mentor, Dr. Bartolito, and I have had the privilege of watching him present it many times. In fact, the latest iteration was presented by my colleague, Mr. Steve Chappell, back on December 27th of 2019 as a special presentation. Now, the 5th secret to making money with VectorVest is learn to trade options. So again, back to why we trade options. It's because they're so flexible and so versatile that they can be used for many things. We're going to focus tonight on providing leverage. Number 2 is reduce risk. You can lower costs, generate income, and you can increase your investment alternatives. Again, there's so many ways to use options in a positive way. The most important thing to remember, however, is that they must be used properly. Right? They must be used properly. A lot of people, when they start trying to learn options, get intimidated by all the terms. I mean, you hear things like delta and theta, straddles, and volatility and implied volatility. It just becomes overwhelming. You feel there's too much information, and you start to believe that only experts can do it, but it's really not the case. So what I want to do is lay out a basic foundation. It may be a review for some of you. Hopefully it is a good introduction to the foundation of options for many of you. It begins with calls and puts. There are only 2 types of options, call options and put options. And there are 2 things you can do with calls and puts, and that's buy or sell them. So you have buyers and sellers, calls and puts. What we've done is created a nice table here, a template to break down the correlation here. So you have calls and puts, you have buyers and sellers. Before I go into that, I just want to really define what an option is. Remember, an option is a contract with strictly defined terms and conditions. Also remember, it's a security in that it trades just like a stock. Right? There's a bid price and an ask price. There's a market maker who's tasked with providing a fair and orderly market just like stocks are. Okay? So keep that in mind as we go through. So the buyer of a call option, we'll start here in the upper right corner. The buyer of a call option has the right to buy or call away. Right? Hence the name call. I could call away stock. I have the right to do that. One contract constitutes control of 100 shares of stock, and I can call that stock away at a certain price by a certain date. Those are the strictly defined terms and conditions. Okay, so a buyer pays and a debit costs money, it pays a premium for that right, but that's what their right is, to control that 100 shares. Now, if you're the seller of a call option, okay, you get paid, but remember, sellers of options, they don't get paid for nothing. You take on obligations, and you are obligated to sell or provide 100 shares of a stock at a certain price by a certain date. We'll switch over to the put side. If you're the buyer of a put option, you have the right to sell or put your stock to someone else. Right? So you have the right to sell 100 shares of a stock at a certain price by a certain date. Okay, and then finally, the seller of a put option, again, takes on obligations. And as the seller of a put, you're obligated to buy 100 shares of stock at a certain price by a certain date if you are assigned to do that. A great way to break these trades down, we put the green arrow through here. These represent the bullish trades here. So if I'm paying money for the right to buy a stock at a certain price by a certain date, my underlying bias on that stock is bullish. Okay, if I'm the seller of a put option and I'm obligating myself to buy shares of stock, right, it would also indicate a bullish bias for the underlying asset. So those are our bullish trades, and conversely, our bearish trades So if I'm selling someone else the right to buy a stock, my bias is that stock will go down in price. And the same thing, the buyer of a put option. I'm paying money for the right to sell my stock at a higher price by a certain date. So those are our bearish trades. And so that's just, we found a good foundation to understand calls and puts and the obligations and rights that go along with buying and selling them. And once you've grasped the concept of this, the most complex option trades there are all based on this template right here. So with that, I'd like to talk about using leverage to profit in a rising market, because that's one of the great things. You can profit whether the market's rising or falling using options. I want to start with a case study using Nvidia. It's a very recent case study, started October 18th, 2021. And what I want to do is open up the VectorVest program and show you again, part of using options properly is the power of using the VectorVest 7 tool to recognize market trends and find the proper candidate for our option trades. Right, so it all starts with the power of VectorVest here, and what I'm going to do is go to a market timing graph first. We'll open up a market timing graph, and it defaults to that 1 year look. I'm going to make it, we'll do a 6-month look at the market timing graph. So this is the VectorVest composite. Why did I choose the October 18th date? Well, because when I'm looking for my option candidates or stock candidates, the first thing I come and do, I follow secret number 3 of the 7 secrets, which is heed the color guard, right? And the timing indicators. So the market timing indicator I like to use is the DEW. So I've just added the DEW timing system here. We do have a DEW graph, but for now I'm just going to leave it here. And on October the 15th, okay, if I zoom in a bit here, we can get a better look. On October the 15th, we got a DEW timing signal to the upside. Okay, all the indicators for our DEW timing system were in place, and we got that up signal. Right? It's a fairly prudent, not real aggressive market timing signal. It's the one I like to use for trading options. And because that signal was confirmed at the close on the 15th, we wake up on that Monday morning on October the 18th and we begin to do our due diligence. Right now my market bias is to the upside. There was some follow through to the upside, and I'm ready to look for my bullish trade to profit in a rising market. The next thing I do is I go to the Unisearch tab within the VectorVest program, because now I need to find the best stock before I can set up my option trade, right? The best stock candidate doesn't necessarily mean it's the best option candidate. But those of you who are familiar with any presentations that I've done in the past in retirement services, the very first search I go to for virtually every bullish trade I ever do is ruler stocks. Why? Because it focuses on relative safety at 1.4 on that 0 to 2 scale just to make the list. Earnings growth rate is another huge part of it. And we can see the top of the list is LPX. It's a builder stock. It's a great company, but I used Nvidia because I want to show the power of leverage on a higher price stock, and why options are so great for that. If I scroll over again just to take a quick look at the power of relative safety, with these relative safety numbers, all of the other VectorVest numbers, price appreciation potential for RV. Relative timing is the one indicator that can fluctuate, but comfort index, earnings growth rate, and if they do pay a dividend, it's usually a very safe and growing dividend. Okay, so that's a quick reminder of the power of ruler stocks, but that's how I came up with Nvidia for October 18th. So using the power of VectorVest, setting up the trades is every bit as important as placing the actual option trade itself. So that is the origin of our Nvidia case study for October 18th. Let's take a look. This is just a graph. I'm going to put some information up on the graph here. On the 18th, right, Nvidia was trading $222 a share and change. Call it 222. So the question is, how much would it cost to buy 100 shares of Nvidia? Right? Because I want to start with the example of just buying the stock so I can compare the option trade to it. So it would cost $22,200 to buy 100 shares and change. So this is our buy stocks long example. It's what we call the what if chart. So we're looking at the stock price and what if it goes higher, what if it goes lower, and what are the consequences of that? Well, we'll begin with our initial price of 222, means we spent $22,200 on the 100 shares. If we were to sell that stock at 222, just that flat price, we would have no profit or loss. So it's very straightforward on the underlying stock. Of course, if the stock went down $10 on 100 shares, we would lose 1,000, and so on and so forth. Same thing to the upside, 232, we would profit, and again, continuing as far as that might go. We know that when we purchase a stock, our max profit is unlimited. Theoretically, it can go to infinity and beyond. And then the max risk, of course, is always going to be our initial cost of the position. Okay, so that's the basic look at owning a stock, which everyone is familiar with. Okay, what I'd like to do now is break down the trade process and compare the leverage of options to just owning the stock. So on that date, we're bullish on Nvidia and it's trading at $222.21 to be exact. So I want to buy the right to buy Nvidia. And the strike price, that certain price by a certain date, remember that certain price in the strictly defined terms and conditions is $220. I want to buy the right to buy Nvidia at $220. Puts us slightly what's called in the money, or for those who are familiar, we want deltas greater than 50 up to 65 deltas. So 220 is the example I'm going to use here, with the stock trading again at 222 and change. So I go out and I buy that call, which gives me the right to buy 100 shares of Nvidia at 220. That's the certain price. The expiration date I used was 60 days out to expiration. So this is a monthly expiration, was December 17th, which as of this recording hasn't even come yet. So that's our certain date, our specific date. So the price is our strike price, and our expiration is December the 17th. Okay, so that's the situation we're creating here. That call option costs $13.60 per share, or $1,360 for just one contract to control 100 shares of Nvidia. Okay, so that's the setup. Now, as I said, on October 18th, Nvidia was trading, closed that day for the sake of our look back, at 222.21. Okay, that's the day after the DEW was confirmed and the market continued to move to the upside. So what happened? On November 2nd, just 2 weeks later, Nvidia closed at 264.01. Okay, so if you had bought the stock at the 222 and change, you had a nice gain of 18.81% just 2 weeks later. Right? That's wonderful. On November 2nd, the Nvidia December 220 call option closed at $46.69. Let's take a look at what just happened and how we compare the leverage to stock to owning the options. So here again is our Nvidia. We own 100 shares. Again, using the exact price there at the close, $22,221 was our initial cost. With the stock trading where it was on November 2nd, the value of that position was $26,401, which would constitute a net profit of $4,180. That's an 18.81 and change percent. Now, let's compare that to the one contract we bought to control 100 shares of Nvidia. It costs $13.60 per share. For one contract is $1,360. Now the value of that option contract at $46.69 times 100 would be $46.69. That's a profit of $3,309. Now for one contract, we're slightly lower than the value of our 100 shares, just slightly. But we laid out a tremendously less amount of money for the position, and the percent gain comes to 243.3% return. Okay, so right there is really the visual definition of what leverage is. Now that's one contract for $1,360. What if you did 3 contracts? Right? 3 contracts would cost you $4,080, still well below the cost of the shares. The value at the $46.69 price would be $14,000. That's a $9,900 profit, which is still $243% return. But again, this is leverage. What if you went up to 5 contracts? It would still cost you a fraction of owning the 100 shares. That's $6,800. $2,300 is the value. Here's the profit of over $16,500 for just the 5 contracts. So I recommend you're comfortable with setting up and placing your option trades before you start to go with more contracts, but I just wanted to illustrate again the visual of the power of leverage, and this is really it on this one slide. Defines what leverage is. Okay, so that's profiting in an uptrending market. You align your trade with the market trend that we find in the VectorVest program, and then we find the best underlying stock candidate before we move on to set up our trade. Well, we can also use leverage to profit in a falling market. And so I'm going to use a very obvious example to illustrate the power of this. On 2/24 of 2020, the DEW timing system went to a down situation. We all know what happened after. That was the pandemic sell-off. The VectorVest program was guiding us towards that bearish look before the big move to the downside. But it would be a great time to place a put option, and in this case I'm using the SPY on the overall market. Of course you can use the VectorVest program to do it on individual stocks, or you could do it on the Qs or IWM or the Dow, whatever you want to do it on. I choose to use the SPY. Now you can do it on the SPY just to simply profit in a downtrending market. The great thing about options is you also use this as insurance to protect a portfolio of stocks that you might have. So that's where we are here, and this is a pretty straightforward example. What happens if you bought that one SPY March 322, that's where the SPY was trading, you buy one at the money put option, it would have cost you somewhere around $7.50 per share. $750 for one contract based on that date. Okay, on 320, right, not even a month later, which would be the expiration for this particular contract. We only go out 30 days for, sometimes on the shorter side, we don't mind going a little shorter term. But on 320, that March 322 put is now trading at 88.89. That's a profit of $81 a share, or just over 1,000%. Now, I'm not sitting here saying that you would necessarily hold it all the way to expiration. Again, this is an illustration. Had you closed that option trade anywhere in here, you would have had a wonderful profit in a downtrending or falling market, or you certainly would have mitigated the losses in any equity portfolio that you have in place. Okay, so very, very powerful way to profit in a downtrending market. That would be buying the put option. My goal in this presentation was not necessarily to make you an options expert in 20 minutes, but rather to show you the power of options when you are looking to leverage your capital to increase returns. So hopefully I was able to illustrate that. And if you would like to have more leverage without using margin accounts, if you'd like to have a low capital, low risk way of profiting in rising and falling markets, stay with me for just a few more minutes, and I would like to introduce you to the Options Jumpstarter course. The Options Jumpstarter course is a 6 weeks to profitable options trading. It's a complete step-by-step system that shows you how to buy calls and puts to profit in both up and down markets. We will take you by the hand and guide you through the exact step-by-step option profit system that you need so that you can leverage your money with options. The outcome of this course is that in the next 6 weeks, you'll be able to confidently find, set up, and manage the right option trade at the right time to make money whether the market's going up or down. So if you're new to options, or if you've struggled with them in the past, this is the course for you. We put this course together for people who want a system to trade options the right way. If you get nothing else from this presentation, understand that your system will determine your success, whether it's stock or option trading, whatever it might be. So a successful system will tell you when to trade, what stock and option to trade, and then most importantly, how to manage that trade. The easiest way to explain it is I can map it out for you. It's a 6-module course, and we'll start in module 1. Called the Option Foundation Builder. It's important because a lot of people try to learn options and get frustrated by all of the terms, or they focus on the wrong things. Here we're going to give complete clarity on how options work. It's a clear and easy to understand framework. So you'll know how calls and puts work, and you'll know which terms to pay attention to and which to ignore so you don't waste time or get frustrated. In Module 2, it's all about the trade you need to generate profits in up markets. It's important because you want to take advantage of those explosive up moves like we're seeing now, because they can really make your year by being prepared for that blast off phase, having successful setups, and being ready to purchase call options in that rising market. Module 3 is similar to Module 2, but it sets you up for profits when the market moves down. It's important, this module, because during down markets, a lot of people get frustrated or angry because their portfolio stalls or gives back gains. So again, we'll walk through the setup for those as well. Module 4 is all about trade selection. Okay, the outcome here is you'll know how to quickly find the best stocks for your trades, for both bullish and bearish, how to match your trades to the market, and how to identify which stocks make the best option candidates. Module 5 is where you learn to prepare yourself for what could happen after you place the trade. Okay, understanding trade management is key. All of these things, in my opinion, are almost useless if you don't know how to manage the trade once you're in it. So the outcome here is you'll have a game plan in place prior to placing the trade, so you'll know when to exit or enter the trade before they move against you. And then in Module 6, it's time to get ready to place your trades. A lot of people learn the theory of option trading, but then have no idea how to actually enter their trade with their broker the right way. Right? If you don't know this, you can go out and place option trades and get burned because you messed up the order. We don't want that to happen to you. So the outcome from this module is you'll know how to place your orders, to enter and exit trades, and you'll have checklists so you can set up and place your trades confidently. There's some bonus modules that go along. After the main course is over, we'll have a covered calls for income bonus session, show you how to sell call options, get paid to own your stocks. It's a great bonus module. If you're not selling covered calls, you should certainly be looking into it. We also have 6 live mastery support sessions. Okay, so the modules come on the VectorVest University website when you sign up for the course. But we also offer 6 live mastery support sessions that will be every Wednesday at 11 a.m. starting for 20 seconds. So we'll walk through live. We'll look at what you're doing and guide you. And don't worry, if you can't make it, we record the session and we archive it in the website later that day. So if you can't make a live session, you can still take advantage of the live mastery support sessions. So order before Monday, December 13th at 5 p.m. and you'll get the best value here. That's our mastery package for just $4.95. That's a great savings off the regular price. Remember, the mastery package will give you the bonus modules taught live as well as the 6 live mastery support sessions. Go to www.vectorvest.com/jumpstart to get more information on the course and to sign up there and take advantage of that price, which goes away on Monday at 5 p.m. They'd say there's no such thing as a risk-free trade in the markets, and that is true. But here, after the course is over, if you show you've done the work and you're still not satisfied, we will gladly give you a refund. So taking this course is, in fact, a risk-free trade for you. VectorVest.com/jumpstart. You have to ask yourself, how much is it costing you not to do this? How much money will you lose by trading options incorrectly? How much potential profit will you miss out on because you don't know how to use options the right way? How much time and energy will you spend trying to do this on your own? And then ask yourself how your life would be different if you do it and it works. And remember, if it doesn't work for you, we'll give your money back. So thank you for taking the time to join me for this special presentation, and I look forward to seeing you in the VectorVest Options Jumpstarter course.